So far, we've talked about having a real business idea, choosing the right co-founder or deciding to go solo, and focusing on generating revenues. Once you have this initial part figured out, then comes the moment where things need to get serious and you need to register your company. And no, this is not optional. This decision will shape how you get paid, how you pay taxes, how you raise money, and how much personal risk you are taking. Across Africa, founders usually have around 4 options: being a sole proprietor, building a limited liability company, starting a social enterprise, or building an NGO or community-based organizations. So let's break them down. The first one is the sole proprietorship structure. This is the easiest and cheapest way to start. You and the business are the same legal person. One registration, minimal compliance. This structure works very well when you are testing an idea, your revenue is still small, you want to take less risk, and it's perfect if your objective is to build your own consultancy and you don't want to get any additional funding from international investors or adding new shareholders in your business. But there is a few downsides about this structure. If the business fails, you are personally liable. That means that your savings, your assets, and even future income can be at risk. It's also not the right structure if you want to fundraise and get future investors on board. So it's good for starting fast, but difficult to scale and dangerous if you stay in that structure for too long. The second and most used structure in the business world is the limited liability company or LLC structure. This is where most serious businesses should land. The company becomes a separate legal entity, your personal assets are protected, you can open a proper business account, you can sign contracts with clients, you can raise equity, you can access loans from banks and get funding from investors and corporates. To scale, this is what banks and corporates need as a structure, but it comes with more compliance. It costs more to maintain with accountants and legal advisors because you'll eventually need a board that oversees all your operations. You'll need a proper accountant to file your returns every year, but this is the structure that tells the world this is a business ready to scale. Third structure is the social enterprise. A social enterprise sits between profits and impacts, and the name of this structure can vary according to the country. Sometimes you hear company limited by guarantee in Kenya, for instance, or sometimes it will be called social enterprise or non-for-profit enterprise and so on. So you'll need to get advice from a lawyer on this. You still generate revenue, but your mission and purpose are embedded into your business model. Your purpose is to make impact. This can work very well if you work a lot with donors and government institutions, but you still have a product and service that generate profits. You receive a lot of grants and you don't want to pay income tax on those grants, but the key risk here is confusion. If your structure isn't clear, investors won't know if you're profit-driven or donation-dependent. So be very clear with your business model and make sure you target specific impact investors that actually understand this structure. Finally, you have the NGO or non-for-profit structure. So let's be clear, the Tungane program saw a lot of funders coming with this kind of structure, but NGOs are not businesses. But if you have an activity, even on the side of your main business that is mostly impact-driven and gets a lot of grants, this is for you. This NGO structure is designed for donations and non-for-profits. The structure works if you rely mainly on donor funding or you work a lot with United Nations organization. You don't plan to distribute profits to shareholders and your mission is purely social. But once you register as an NGO, you cannot raise equity, you cannot distribute dividends, and many banks won't lend to you because they will lend to for-profit organizations. So it is possible if you have a specific objective, but you cannot scale like a normal company. So here's the mistake we see too often. founders register the wrong structure too early or stay in the wrong one for too long. My advice, start simple, get your plans clear, then register the structure that matches where you are going, not just where you are today. Make sure you think long term. Because once you're ready to raise money, sign big contracts or access financing, your legal structure will either open doors or quietly block them. If you need any templates, country-specific guides, or checklists on company registration across Africa, join our Tungane community. We've built a full knowledge database for founders on the continent so you don't have to learn everything the hard way. Remember, we're in this together. Tungane, let's unite to build the Africa we want.